Today I'm going to share with you 5 of the best investing secrets that you can apply to your investing strategy right now that will immediately improve your gains and your overall portfolio performance. Let's get into it. How's it going, guys? Ryan here and welcome back to another investing video, and today I'm giving you 5 of the best tips for beginners that will immediately improve your investing strategy and the performance of your portfolio. But before we get into that, guys, please remember to give this video a thumbs up. It helps me out so much with the YouTube algorithm, and subscribe for more investing, stock market and wealth management content. I'd love to know your thoughts on these tips down in the comments section below after you've seen the video. So without further ado, let's get straight into it. Investing tip number 1, don't bother timing the market. If you're going to be trying to time the market for the best time to enter a certain stock or the stock market in general, it's never going to happen, because there is no perfect time to start investing in a stock or the market overall. You'll constantly see fluctuations day to day, whether it be up or down across stocks, but your outlook needs to be longer term when it comes to investing. That means these day-to-day fluctuations really should not influence the point at which you invest in a company. You should be focusing on the fundamentals of the company as opposed to the market as a whole. Obviously, if the market is going through an absolute terrible day where the Dow Jones has dropped 2, 3, 4, 5%, maybe that's not a great time to get into it, but that actually provides you with a buying opportunity. So don't let the state of the overall market define whether you enter a stock or not enter a stock. Instead, use it as a overall indicator of what the price action is going to be on the stocks you are currently holding or you're looking to enter, rather than something that prevents you from entering those stocks. Investing tip number 2, stop losses are not price based when you're investing long term. And now you think, okay, a stop loss is a term that's generally used in trading, which is your exit point. As soon as this price is hit, you're immediately going to sell your shares. If it's a trailing one, it obviously is following the price, or if it is one that you've initially put into a stock, that is where the price sale is occurring in order to reduce your losses as much as possible. But when it comes to investing, this is actually not the case. When we look at long-term investments, we're investing in the company itself as opposed to the share price at this point in time. Due to the long-term nature of the investment, this means we cannot base our stop losses on the actual share price. Instead, we need to base it upon fundamentals of the company. So what does that mean? Well, effectively it means you should be investing in companies for certain reasons. So you'd have your list of criteria. Let's say you've got a company that you're invested in and your criteria to buy was no debt, cash on hand, awesome future outlook, great management team, all these sort of things. These are the boxes that have been ticked for you as a fundamental investor. Now, your stop loss occurs when one of these factors changes. So that effectively means, for instance, if you have, as an example, no debt, and then all of a sudden your company needs to take on a 100, 200, 300 million dollars of debt that they cannot pay back in the near term, what's going to happen there? Well, effectively the share price is going to cop a hit. And as a result of that, that would be an indicator for you to exit that stock. Obviously, if that debt was in the plan, different story. But if they've had to take this debt on unnecessarily, then that is a reason for you to potentially exit that stock. So make sure you're focusing on the fundamentals as a stop loss, a change in the actual story of the stock, as opposed to price fluctuations when it comes to long-term fundamental investing. Investing tip number 3, do not trade long-term holds. And this is an issue that I personally have experienced myself, and it's letting my emotions basically get the better of me. I can see an opportunity potentially for when a stock rises, then selling it and hopefully being able to buy back in at a lower level. This is not a good strategy to have, and there's a few reasons for that. The first of which is your original investment plan is to invest long-term in a stock. If you start then buying and selling the stock, trying to hit those peaks and those troughs, what you're doing is not actually investing, you are trading. Yes, you may get lucky, you may be able to pick those highs and pick those lows in order to exit and enter and maybe make some profit on the side and keep the same amount of shares or accumulate more shares with that profit. But what you're doing is effectively mixing two trading and investing techniques together which conflict against each other. For instance, if you're long-term investing, you've got those long-term goals in mind, and effectively when those goals are met, that is when you sell, whether it be, it hits $1 a share and you've invested since 40 cents, for instance. But if you're trading it going 40 cents to 50 cents, back to 45 cents, back to 60 cents, back to 55 cents, up to 75 cents, you have margin for error there. And there is a potential that you're going to lose money. So I suggest if you are doing this, you need to do two things. The first of which is establish two separate trading accounts. One for trading itself and another for the long-term investment, and that holding you do not touch at all, whereas the other one is more fluid and it fluctuates. The second is develop two separate strategies. Make sure you have one strategy for these shares over here which you're holding long-term, and a completely separate strategy over here for the trades. And the trades should be opportunity based. You're in and you're out. But what you don't want to be doing is those trades with your long-term holding, because you could potentially miss out on massive gains, for instance, and that is something you don't want to do. And by holding long-term, you got to remember that if you hold the stock for 12 months or more, you pay only half the capital gains tax. If you're constantly buying and selling, you're not going to be able to do that. So basically, you want to separate these two strategies. You want to separate the shares and have two separate accounts if you're going to do that. But in my opinion, I would just completely eliminate that in general. Focus on your long-term investment or focus on your trading on that stock. Investing tip number 4. It is better to top up and increase your holdings in a stock you already hold than to go out and find a new stock to invest in. Now, why would that be the case? Well, effectively, it's due to the fact that the companies that you're currently invested in, you've done your research, you know they're going to perform well. So why would you not put more money into these stocks as opposed to going out, finding a completely new company, taking a new risk, potentially one which is a lot more riskier than your current investment, and having the possibility of losing that money? You have more certainty in making money off the stocks you know are going to perform well than you do on finding new stocks to invest in, particularly if you're investing in the microcap sector where it is very, very volatile and anything can happen. So for that reason, I'd suggest you focus on topping up your existing holdings on the stocks you understand, the stocks you know are going to do well, and increase the amount of money you are going to make with a lot more confidence and a lot less risk, as opposed to diversifying into potentially more risky areas. Obviously, if you only hold one or two stocks, it's probably a good idea to diversify into a few more. But if you hold, let's say, 5 to 10 stocks already, just accumulate those stocks which you know are going to perform well. You've got your price targets in place and you know where these stocks are going to be. Make sure you leverage the buying opportunities that present themselves from daily price fluctuations in that region, as opposed to taking on more risky investments and the unknown. Investing tip number 5. If you have to justify an investment, it is not worth it. Basically what this means is a stock should speak for itself. That company itself should prove to be a valuable investment, and you shouldn't need to prove to yourself that you are making a good investment or you are going to make a good investment in a stock. It should be loud and clear. You do not need to go hunting nitty-gritty to find new opportunities. These opportunities from just reviewing announcements and news will present themselves to you. And basically what this means is the stocks, if they perform well, will perform well as a company. And effectively, the operations of that company will show their ongoing increased and better performance over time, and as a result, an increased share price. If you're having to justify to yourself or to others why you've invested in this stock, then it's likely not a good investment, as opposed to when you can just lay the facts out there and say, this is why this company is good, as opposed to getting emotional and having to prove yourself. It should be very obvious that this stock is worth investing in. So as a result, if you're having to justify to others or to yourself why you've invested in a stock, then it's probably not a good investment after all. And that wraps up my top 5 investing tips for beginners. I hope you did enjoy today's video, and if you did, please remember to hit that thumbs up button. It helps me out so much with the YouTube algorithm, and subscribe for more content like this. We talk about crypto, wealth management, the stock market, and investing in general. Please as well let me know your thoughts and other investing tips down in the comments section below. And with that, guys, I hope you have an awesome day. I'll see you next time. Cheers.